Hi, everyone. So this is YMP TV. And as you know, we've been doing those interviews with executive in the mining sectors just to ask them what is going on during this COVID-19 period and how has it impacted them. So today we have Shaun Usmar, founder and CEO of Triple Flag. Hi, Shaun. Thank you for joining us.
No, thanks for the opportunity. It's actually just great in this time of social isolation, seeing more faces. I appreciate it.
My pleasure. I agree. And so speaking of COVID-19, how has it impacted Triple Flag?
Look, I think this is something that none of us have endured in our lifetimes. It's clear that we're seeing uncertainty and volatility like we've never seen before. I think at the same time, wearing a Triple Flag and a streaming hat, we're very fortunate. I think it points to sort of the resiliency of the model. Where we've seen around the world mines closing for government mandated shutdowns. Some of them are starting to come back on. We've definitely had some that have been affected, and we've seen that with all our competitors and peers. And I think despite that, you'll see even today, looking at the screen, like Wheaton Precious trading at its 52-week high. I think we saw Franco Wheaton Sandstorm this week hit their 52-week highs. And that's with assets down, oil prices being low. So it's been pretty impressive for the sector. For us specifically, I think we've seen quite similar impacts. On the positive side, we just had Monday was our 4th birthday. 4 years ago, there was nothing. It was just me and
happy birthday to Triple Flag.
We'll celebrate when we're back, but it was we got 12 very talented people now, a couple of offices, 39 assets constituting about 37 mines, and of those we have 12 now in operation. We've got 3 ramping that have just started production, a couple that are in construction that should go through soon. And when I look at the impact of COVID specifically, I think it's been different in different areas. So we saw Peru with our Cerro Lindo asset go down. You saw this sort of rolling sort of 2-week shut that hopefully a couple of weeks from now will be passed. We saw other regions like South Africa and that closed. They're opening now. So our RB Plat asset is coming back online. We've seen other areas where even though assets, they haven't had necessarily a government mandated shut, they've definitely been indirectly impacted by supply chain or the inability to get key skills into the country. And even despite that, like you see this sort of innovative spirit that defines the sector that I love. I'll give you an example. We invested a few years ago in a very small asset in Mongolia, decent return and a team that has an ability to operate there. And despite closed borders, despite not being able to get expats in from Australia and New Zealand, Step Gold poured their first 13 bars of doré in the last week. We've seen our Aussie project down in Dogs, where they've gone through earlier this year, record fires, those terrible bushfires in Australia, followed by these sort of biblical floods and things that impacted their build. They just shipped their first concentrate this week. So even in the midst of this chaos, you see, that's fighting spirit of this sector coming together. So we've been fortunate. I think this year, as long as we don't see even more unforeseen shuts and things of that nature in maybe a second wave, for example, we should see quite significant cash flow growth in our business this year.
So there seem to, streaming and royalty companies seems to be doing good, and despite the situation, do you expect the need for financing through streaming and royalty will increase in the months to come, or maybe the year?
I think there's a good chance that you will see that. I'll give you some examples. Firstly, my immediate indicator, in our 4 years, we've had a grand total of 2 weeks where we haven't been active on deal execution, deal work, and that was early on. But at the moment, our pipeline is very full, and the team Even though we're all working remotely, this is the end of week 7. It's proven to be reasonably efficient, and we're at capacity on a number of deals that we're active on right now. I think in some ways we're seeing signs that the sector has entered this downturn better than we might have seen at the global financial crisis and others. But I can see, I don't think in forecasts in this environment. I think the uncertainties are so vast, so unprecedented. You have to really try and think in terms of scenarios. And there are scenarios where, this isn't, someone coined it a COVID blizzard. It's more like a COVID winter. This will take time. And whether it's a year or 2, who knows? But I do think businesses that perhaps can't access capital markets, who perhaps have more leverage than they need, or maybe see as the economy starts opening up again, maybe demand shocks through the entire supply chain. I think those price impacts could actually end up providing opportunities for stream financing to help mining companies. It's been pretty apparent to some of our partners in this time, where if they had debt financing in place of the stream financing, when they go down, they still have to make interest payments, right? We share that. We share that that outage, for example. We share that risk with our partners, and for us, it represents really a deferral, obviously, of revenue. So I do think that there should be more opportunities, and my hope is that when you look at the likes of Franco Royal, Wheaton, going back to 15, 16, when I was at Barrick, you saw at that period, as companies like that were deleveraging, really some generational assets, some of these beautiful assets which they were able to acquire at that time. And we're fortunate with our backer in Elliott. We're private. They've got about a little over 40 billion now under management, and they've come through this crisis extremely well. I think they're actually up in a market that is obviously down. There isn't a check, I think, out there that we could not write for the right quality asset. So we're focusing on that, and to see if we can put money to work, and then also find some good partnerships for the long term.
And I guess speaking of the supply and demand, with the current crisis, we've seen mines and refiners shutting down. What do you think is the outlook for supply and demand in the precious metal sector?
I think, like a lot of your listeners, I think nobody has a particularly good crystal ball. We've seen trillions of dollars of stimulus from central banks and governments that, on the face of it, are pretty constructive for precious metal prices. And I could see scenarios where, when you look at prior cycles, that old story, history doesn't repeat, but it sure does rhyme. There are scenarios here where you could see significant outperformance of gold. And even though silver tends to lag, and we're seeing this sort of significant, gold-silver ratio at this time, which is quite unprecedented, over 100 times. Typically, it's high beta and it tends to lag. And so my hope is that there's scenarios here where you won't only see potentially significant upside asymmetry in gold price, but indeed in silver prices and into the future here. I think the real question for me, though, is that the markets have rebounded back, the financial markets, reasonably quickly. But a lot of that, I don't think, really represents the underlying reality of the actual economy. And even though you're seeing China come back in, the real question is, with their factories starting up, how does that tie in with consumers ultimately in the West and elsewhere that need to buy their products? Are they even open for business? As they open for business, are people, frankly, going to want to go and have a tattoo or a haircut with the social distancing concerns, even if politically people have opened these things up? So what does that then mean for the consumer? What does that then mean for, frankly, the level of personal and business indebtedness and leverage? I think that we're only in the early innings of that. So what the implications are going to be for the volatility and uncertainty in this market, I think we're going to see in the back end of this year and perhaps later. If I look at it, I think the US, as an example, entered this crisis with government and personal GDP over 210%. I think China was 310%. I think we've seen another 10% of GDP coming in. There's probably another 10% as this year goes on. So, leverage, even with these low interest rates, I think is a significant point. So putting all that in, it seems to be very constructive for businesses that have liquidity. It seems to be constructive for precious metal prices. I think some of the estimates I've seen in Q2 is that the gold production has been affected by about 1% of global supply. And I'm sure those numbers are going to continue to get revised. I think silver, there's been large inventory levels of silver, and there still is. But between Peru and Mexico, and I think Mexico has just extended their shuts to the end of May now, you've got like 40% of global supply that's impacted there. So there's definitely been a bit of a supply impact on silver as well. But put it together, I don't know anybody who's got a good crystal ball. And I think I'd encourage everyone to be really thinking more in terms of, almost reverse engineering for their own businesses and circumstances. What would different scenarios look like for their own particular outcomes? And I think that's the reason you've seen businesses, pulling their guidance, for example. It's really hard to call the future right now.
So I guess, again, speculating a bit on it, but do you think the mining sector or the mining industry, mining companies in general, will act differently or operate differently in a post-COVID-19 world?
I think inevitably they have to. Firstly, if you go back in history and you've seen these very large world events, it does have a psychological impact on people. It has a profound impact. And in some ways, it forces society to innovate. And, I think already we're all seeing that, the world doesn't end when, if you have the capacity to work remotely from home, rather than jumping on a plane for a 2-hour meeting, it can actually be fairly efficient if you've got an established relationship. I think the commercial real estate space is going to have a tough time coming back because people are going to question just how much space they need. And, mining head offices, do we need to pack people into those offices, and how many of them can work remotely? I think you're seeing a cost structure reset, and I'm seeing this right now in some of our assets where executives are looking across their assets, particularly single asset businesses, and saying, well, the overhead burden on the business is higher. They're using this opportunity to say, what do we truly need at an operating level? How do we reduce our cost burden? I think people are questioning their supply chain resiliency. It's quite clear that there's been substantial disruptions. And I think if that means in the future that you look at multiple sources of supply or, multiple refiners to take your product with the shuts, people will be considering those risks if they haven't already a little bit more carefully. Clearly automation. And if you're in a remote site, and particularly right now, there are communities in those sites who don't want to see people that look different or come from outside in there. And I think it will force people to think a little bit more about those situations and circumstances. I hope when I think of the mining space, I think I see too many management teams that are reactionary and don't spend enough time thinking about scenarios where, frankly, things can and do go wrong until they're forced to. Leverage in those situations is not good, of course. And then once you're in that situation, it's hard to fix. But I do think this is forcing businesses to, frankly, because of it's Darwinian. That old story when the tide goes out, who's wearing swimming trunks. It's important at this time, I think, for those guys to really look really hard at every dollar they spend, to focus on liquidity and to make sure that they're as productive as they can be. And I think I'd like to hope that the focus on that going forward would be there. I think one concern I've got longer term as we emerge out of this, one thing that's clear is governments are going to be more indebted, and at some point they are going to look for revenue, additional revenue. So and I think there's a chance you're going to see more nationalism as well. So what that means potentially for on the supply chain aspect for investment more regionally to secure those supply chains, it could be an interesting opportunity. But at the same time, it could also represent challenges to miners seeing their royalty rates or their tax rates go up potentially in the future. I think there's, in the extreme expropriation risk, which hopefully will not be an issue. But, a lot of the assets in the world are in, different locations. They're not in downtown Toronto anyway. So the world is going to be different in unknowable ways, and we can make some guesses about that. But again, I think the best thing we can do is to try as best we can to think through those scenarios and indeed how we might react to them ahead of time.
Okay, so I asked Pierre Lassonde that question a couple of weeks ago, but I want to hear you on it, just your thoughts. Do you think streaming and royalty company will do better during and post-COVID-19 world just because of their business model? Like, would it make them more resilient and attractive to investors or mining companies?
Look, nobody can give a more charming answer than Pierre. So, but yeah, look, on the one hand, you'd see me talking my own book, but there's a reason my career has always been as a mining guy, and was in operations and then, executive management, and on the mining side always. What drew me to this is indeed the risk-reward characteristics of this space. It just seems like quite a unique characteristic. And I think people often say, particularly when you start seeing outperformance in underlying commodity prices, that you get more leverage investing directly in the equities of some of these businesses. But I'd argue if you look at Pierre's business as an example, find a better track record than what those guys have done. It is truly impressive. And I was looking back, I mentioned the fourth birthday. I had an advisory board meeting this week. And I started that by just looking back 4 years ago what the world looked like on the 27th of April in 2016 versus what it looks like today. And as part of that, I looked at the share prices of some of the competitors that are listed. And it was quite interesting to me that when I look at Royal, Franco, Wheaton, Sandstorm as an example, even though there's quite significantly different scales to those businesses. Sandstorm's appreciably smaller than Franco, for example. Franco's got a lot of oil and gas. I think nearly a quarter of its portfolio is in the oil and gas space. You'd seen quite similar share price appreciation over that period. And I know it's a point in time, right? But it was about 120 to 135% increase over that period of time, which I thought was quite notable to me, that despite quite differences within those portfolios, you do. And I think when you step out for a minute, the fact that these models have low G&A, they are highly diversified typically. So even if you have one or two significant or 4 or 5 assets out, you still have the benefit of other cash flows coming in. You still get the torque and the leverage to, increases or changes in pricing. You definitely, when you look at, for example, Royal Gold does a great presentation where, having been around as long as they have, you have a look at the life extension that they've enjoyed over time, where they've actually got the money back from their investments, and they've still got these significant life extensions from these investments that they've made. So that optionality, which is really quite unique. And, like our portfolio now of the 39 assets we've got, I don't have any other obligations to invest. I've got, we did 40,000 gold equivalent ounces last year. At this point, we will increase most likely quite significantly this year on that number. Within a couple of years, we will be over 100,000 gold equivalent ounces with no incremental investment. That's just fully funded stuff that we've already invested in. So the sort of leverage and torque that you've got built into that already is really quite significant. So it's a long answer, but clearly I've drunk the Kool-Aid, and I think it offers a really interesting risk-reward trade-off.
So then what would you, on that terms, I guess, what would you tell an investor who is new to streaming and royalty companies in terms of investment? What would you say to them?
Yeah, so look, the resource investors, the specialist investors out there who've frankly been in the hurt locker for years with redemptions. I think they've finally stopped seeing redemptions now, but I haven't heard that we've actually started seeing more money coming into these funds. At least that has stopped, which is great. But the generalist investors, I don't think there's strong signs that we've started seeing movement from them yet in the space. So that's hopefully an opportunity. When I look at, we looked to do an IPO last year, and even though we got an offer, it was at a valuation we thought we didn't need to take, and we didn't need the capital, so we didn't take the offer. But we had a lot of high quality generalist names in that, and I think that's one of the appealing things for streams and royalties, is that it does appeal more naturally from a risk reward perspective to those generalists. So if they want exposure to gold with very low associated underlying overhead or costs, optionality, which is quite unparalleled to it, a high level of diversification, it's really hard to beat. I also think one investor put it quite succinctly, because we were getting feedback from these guys on how they thought about it. And, they said, look, we know you guys love messing around with, recoveries and grades and tons. They said, I really don't care. I just want to know that I'm going to get gold exposure, and it's going to continue to grow, and I'm going to get a decent dividend, and ideally it's going to be progressive. And I think that's really the Franco story, and the story of a lot of the peers in this space who've done so intelligently, and I think built a really impressive track record. And that's what we're aspiring to do with this business. So that's what I tell them. I think it's it's better than an ETF. It's better than investing just directly in individual assets, and particularly in polymetallics where you're streaming. It's symbiotic, and you've got asset lives which you don't necessarily get just from traditional gold companies, for example.
And I guess more at the company level, but how does Triple Flag decides to enter into a royalty or streaming agreement? What are you looking for? Is there a preferred asset or a preferred jurisdiction? What is it you're looking for?
Yeah, so it's a great question. Look, I mean, the first point I make is when you look at our portfolio right now, and from the beginning, we've looked in the traditional hunting grounds first and foremost. So the Americas, Australia, maybe parts of Europe. But we will look jurisdictionally elsewhere if we can find a compelling reason to do that from a risk reward perspective. And we know that the security of tenure on that investment is good, obviously a great quality asset and a good partner. The challenge on that is we're not operating those assets. So if we don't like the management or whatever else, we're not displacing them. That's not the model, right? We're not invasive. It's also quite conceivable, unlike equity investors or even debt investors, we're going to be in these assets many years to come. So we're always trying to take that longer term look. And I think that's where, just personally having long-term private capital from the likes of Elliott that has an indefinite time horizon is a real advantage to us. We're not trying to pick the highs and lows or make a quick flip here. We're really looking at it through a long-term lens and understanding the optionality that comes with that. So when we look at these investments, first and foremost, we're looking ideally jurisdictionally in areas that are less likely to be complicated, if I can put it that way. Unless we've got those exceptions. And like our second last transaction was RB Plat as an example, with an exceptional circumstance. And even there, we always look at it on a portfolio basis. So we model it, we look at a pro forma, and we try and understand what proportion of our overall net asset value and what does it mean for diversification if we do that, and we size it accordingly. So it's not accidental. The underlying asset quality, more than 80% of our assets are, first, second quartile. We've got only a couple of assets that would be sort of, fourth quartile, for example, and typically we don't invest in those higher quartile assets unless there's a very good capital structure or reason to do it with some abnormal returns. Primarily for us, and it's the same I think in people's lives and careers and business, frankly, life's too short to do business with people you don't trust or frankly, you just wouldn't want to do business with. We've been very fortunate, even though we have been involved in all the bank-led processes that typically get done out there. The bulk of the deals we've done have been bilateral. We put a lot of ideas in front of people, as I'm sure our competitors do, and I guess at the end of the day, we come at it always from having sat in those seats, having to consider some of the trade-offs that they're doing. And at the end of the day, we're trying to structure deals that, frankly, you can't have a winner and a loser. Because if someone loses, if it's us, that's terrible. And if it's the mining partner, that is a terrible advertisement for the kind of financing we're providing. So I like to think of what we're doing as something that provides depth to this market, some additional legitimacy to a financing sector that at one point was fringe, and ideally will really be helpful to to mining companies and mining partners into the future. So those are some of the characteristics. We're primarily precious. 85% of our business is in gold and silver. We've got the rest is really gold and a small amount of diamonds and nickel. And we'll maintain the precious focus on this and continue in this market in particular, try and look for primarily operating gold assets, probably byproduct driven in most cases where we're not competing for primary. But yeah, that would be most of what we'd be going for.
So after 4 years of existence, what's next for Triple Flag?
Yeah, boring is not a bad thing. So in a world that's not so boring right now, on the one hand, look, we are staying close to our mining partners. If there's things we can do to help them, we're sharing best practices with our team in South Africa or their partners in South Africa. We put $100,000 scholarship program in place early this year. We've got 7 students we're sponsoring. We've actually just helped them with more money to learn remotely so that they've got the means to do that. We're looking to put some of that additional money at work to help some of their communities impacted through COVID. And I noted what Randy did at Wheaton recently with their fund, and we're looking to do something similar. I think the sector has the means to do that, and this is a time to really help your partners and communities. And then in the meantime, it is looking to see if we can find good ways to continue to add to our portfolio. We've been fortunate to be very active since we've started. We've learnt as we've gone, and we're going to continue to look to make some smart investments as we go along. And our partners in Elliott are very, very supportive of that.
And as a mining executive, what advice would you give to a young professional starting its career in this period of crisis, or to a young professional wishing to, enter this mining industry?
So, I'd say be brave. And by that, I mean, it's quite easy with the 24/7 news flow, just this massive uncertainty that we're seeing, for people to be overcome by it or to be defined by it. And I understand that we're all in different stages of our lives and have different financial and other circumstances. But if I think about it, I graduated high school on the year Black Monday happened with the market crash. I've made career changes at times when markets were really tough. For example, I finished my MBA in the US and started in corporate finance in London, just after the dot-com crash. And when I look back at it, a lot of the times when I've made these moves, this industry is defined by ups and downs. The downs really represent opportunities from my personal experience. There are times when, if you're entering a business that is overgeared, like when I went into Barrick, the challenge there was that here's a business with 13 billion of debt that's hemorrhaging nearly $1 billion a year. What a cool problem to be able to work on and try and actually make a difference. And so I think if you can find yourself opportunities that are meaningful, where they could actually be defining from a career perspective, from an experience perspective, and I think if you find those sorts of challenges, very often the sort of financial rewards over time tend to reveal themselves. Sometimes they don't. I mean, there's obviously no guarantees in life and there's risk, but I think you do have to embrace that. I think the other thing is this is a great time just to absorb the possibilities that emerge from it. And I define that really through people. I've been fortunate in my career to have some amazing mentors, some extremely demanding bosses and leaders at times, but people who in general are gravitated to because they had an ethical or a value set that to me really resonated with me. And I've turned down jobs which would have been very lucrative, where frankly, I just didn't feel I'd either be able to look myself in the mirror or be proud of myself. And I couldn't say for sure, but that was my gut. And I think everyone ultimately has to be able to make those judgment calls for themselves. So I think importantly, touch base with as many people as you can, form your own opinions. Don't be mesmerized necessarily by title or the money, but think a little bit longer term and look at the people that you tend to get your life entangled with, and make sure that these are people that you can respect and admire, because I think it's really important. And then finally, this is a sector, I think generationally, that's past its sell-by date. I'm Gen X. There's not a lot of Gen Xers necessarily that were in here. I was the only person in my Kellogg year at Northwestern of 600 odd MBA students that was in the mining space, for heaven's sake. And the millennials and others, there's a wave of boomers that are, if they're on out the door, should be pretty soon. So I think there's some great opportunities that will emerge. I do think, though, that the sector needs disruption and innovation, and that we don't have the scale or the money that we've invested for that to come mostly from the sector. That's not an absolute truth. You've got Rio and others who've been investing, but for your run-of-the-mill mining company, I really think we have to look to other sectors and be alive to those and actually integrate those technologies and innovations in order to become, frankly, more innovative in what we produce for our customer base. So I think just looking, reading, exchanging with other people entirely out of the sector. On the one hand, it's fun, but on the other hand, it may just spark an idea where you've got the knowledge of the mining space and this new innovative thing that maybe someone else hasn't thought of, and you can bring it in, implement it, and make a difference. So I think this is a time which really is an opportunity, and I think people have to see it that way.
And Shaun, do you have any last piece of advice for investors, including our millennial members that are listening?
Yeah, look, on a personal level, when I look at where we're at, the one thing we can be sure about right now is uncertainty. And it does feel a little bit like, as I said, the financial markets with all this stimulus have gotten a little ahead of the fundamental economy. I think if you've got liquidity and you have the ability to have a slightly more defensive posture in your investments, I think that could be helpful. I'd rather miss the peaks and the troughs and have the ability to deploy intelligently than not. I also think I'm getting involved in as many things as I can to try and think around what's the future emergence of this going to look like on whatever timeframes. Not because I've found any one source yet that frankly knows. Of course, no one does. But I think the more you hear this, and at times quite contradictory views on that. I had a debate with someone earlier today where we were talking about how willing people are going to be to jump on a plane after this and go on a boat cruise or something, which I don't think seems like a rational thing. This person really felt that the human condition was such that people are just going to have, despite the apparent risks, are just going to want to get out there and do that kind of thing. And who knows? Maybe, I don't know. But what I do think is there are sectors that are going to have been profoundly impacted. I think, as we watch this unfold, there are going to be interesting opportunities, and you're not going to be able to take advantage of those if you have a very defined single point of view. Flexibility has value here. And I think the ability to actually act on that flexibility could really be quite defining for you from a wealth creation perspective. It's what I like about streaming and royalties. But just in my personal life, that's how I'm trying to look to the future. I think it's a fascinating time.
I think so too. And thank you, Shaun, for taking the time to speak with us today. I mean, we've decided at YMP to do good with those interviews as well, where we make a donation for each interview that I record. Hopefully, I'll do a couple more during this time of pandemic, but we give those funds to United Ways in Greater Toronto for those in need during this period of COVID-19, mostly students that lost their jobs or...
I think that's fantastic. I'm involved in Make-A-Wish Foundation for Canada.
Very good.
This is a time where nonprofits
Absolutely.
are taking serious strain, and your people are really needed. So well done, and thank you for the opportunity.
Thank you, Shaun, and take care. Stay safe.
You too. Take it easy. Have a good one.
Thanks. Bye-bye.
Cheers.